Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is our live Q&A, and I can see a bunch of folks already in the chat asking questions, which I will absolutely get to. Would appreciate a thumbs up if you can hear me. That's probably more important than seeing me, but although some would say no, actually. Anyway, give me a thumbs up if everything is good. If you're new to all of this, Tyler, thanks for the thumbs up. So you can ask questions in the chat. Just tag me in your question, or it could just be a topic you want me to cover. So that's number one. Number two, when this is over, I will do timestamps below the video. So if you're watching this later, and I get these emails all the time, it's 2 hours. I can't watch 2 hours. Well, that's okay. But there are timestamps, so you can skip to whatever topic might be of interest to you. I do have a couple of things I want to talk about before we jump in to your questions. So I get requests all the time from advertisers to advertise their whatever on the channel. And the vast majority of them I delete. I actually had one, I think my favorite so far is a bidet. I don't know. I don't think selling bidets on my finance YouTube channel, I don't know, maybe that's what you guys want. Anyway, I deleted that. Not that there's anything wrong with them, just didn't seem like it fit. So one of them that reached out to me, and I've mentioned them before, is Capitalize. And they offered to sponsor a show. I decided not to do that, but they are an advertiser. I haven't talked a lot about them, but they help you roll over a 401k to an IRA. And what I thought I'd do was actually use them. It seemed like if I were going to advertise, they're going to be an advertiser, even just on my blog, not even the YouTube channel. So I left Forbes recently as an employee, which was planned. I'm still a contributor, so I still can write for Forbes, but I'm no longer an employee, so I no longer have access to the 401k. And the 401k was with ADP. And so I thought, well, this is perfect. I'll use Capitalize to transfer my ADP 401k. And it was, I guess, complicated in the sense that I had a Roth 401k, but there were also matching contributions from Forbes. And if you've had that, you know that even if you contribute to a Roth 401k, employer contributions always go into a regular traditional 401k because taxes haven't been taken out of the employer contribution. So effectively, I had two 401ks, and they get rolled into different IRAs, right? The Roth gets rolled into a Roth IRA. The matching contributions that are in a traditional get rolled over into a rollover IRA. And so I signed up for Capitalize, which is free. They don't charge you anything. And you actually connect your accounts, both your current 401k, and you can either create a new account for an IRA, and they will help you pick one, and that's how they make money. If you choose to open an IRA with a partner of theirs, they get a fee from the IRA provider, but you don't have to. And in fact, in my case, I already had an IRA, an existing IRA, and you can use those as well. So they don't make anything off of me. So they set up a Zoom call. And they're literally going to get on the phone with me on Zoom and walk through exactly what I need to do with ADP. But they sent me an email ahead of time and said, if you want to do this on your own, here are the steps. And it was literally, go to this screen, click that link, go to this screen, click that link, select this. I mean, it was step by step, very easy. So I did all that. And I got checks. I'm holding the two checks right here. I got checks from ADP. You have to indicate how they should make the check out to, and Capitalize tells you that as well. And of course, it's going to vary. So like if you were going to, I don't know, let's say you're going to open up at Schwab. The check is going to be made out to some sort of Schwab entity for the benefit of your name, right? Whatever. So that's how these two are made out. One's for the Roth, one's for the rollover. So they came in the mail. And so now I need to send them to where I'm opening or where I have my IRA. And so I don't know how a company, honestly, I don't know how they're going to stay in business. So Capitalize sends me this. And in it are instructions that I've lost. Instructions. One sort of just a generic instruction page, but the other one is instructions that I'll send to where I've got my IRA that literally says, this check goes into that account. And they sent me a self-addressed stamped priority mail envelope. So I literally just take the checks, stuff them in the envelope, take the instructions, stuff it in the envelope, and off it goes, and I'm done. So I got to say, it was pretty easy. There was one hiccup. In the instructions I'm supposed to send to my IRA company, it only has instructions for the traditional. rollover IRA, not the Roth. Now, as a practical matter, that's not a big deal because the instructions literally say deposit this into, and that has the account number I have with my IRA provider, which I'd given to Capitalize. So all I have to do is handwrite in the account number for the Roth. And they tell you to do that on the checks in the memo as well. So it's an easy fix, but I decided I was going to log into my Capitalize account and ask this question. I've got 2 checks. You've only given me instructions for 1. What do I do? So I'm kind of playing dumb. Some would say that's not hard for me. In any event, I submitted that request around 9, so 2 hours ago. They say they usually respond in under 3 hours. They haven't responded yet, but it was early. I don't know if they're West Coast. I'm not sure where their offices are located. But we'll see if they respond. Anyway, so far it's been I've liked the service a lot. Now I will tell you, if you're going to transfer a 401k to an IRA and they're both at the same company, they're both at Vanguard or they're both at Fidelity, you don't need any help at all. I mean, it's, because the money's not, they're not going to send you a check. It's all very, very easy. But if you're going to go from one financial institution to another, it's not that it's complicated, but I mean, Capitalize did make it pretty easy. I've done it on my own. I've done it obviously now with Capitalize. I like them. So that's the first one. That's the first thing. The second thing is Haven Life. So I got this email, not from Haven Life, from a different life insurance company, and they wanted me to promote their life insurance. And if you've watched this channel for a long time, I don't really talk a lot about life insurance. I probably should do a couple of videos on it because it's important. And I have strong opinions about the fact that you really generally only need term life insurance. Very, 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 very few people ever need permanent life insurance of any kind. And you don't need it when you're old like me, generally, unless you've got someone relying on your income. So I don't have life insurance anymore. Neither does my wife. But in any event, this company that emailed me sold term insurance, fine, but they also sold whole life. And I guess most insurance companies probably sell both. So but I just, And so, I have Haven Life, although I've never promoted them. And I thought, I'm going to check out Haven Life. And I've got a link below the video. And the thing I liked about Haven Life is that you can get an estimate of what it will cost you without giving them any contact information, no phone number, no email. And I thought that was pretty good because most of them want to capture that so they can then harass you. And you can get an estimate. My estimate, I put in, so I'm in my 50s. And I put in a $500,000 policy for 5 years. And I think it was $80 a month. It was the estimate, which given my age is probably pretty good. The last policy I owned, which I canceled several years ago, I bought in my 30s. And it was obviously a lot cheaper. In any event, I've never bought from Haven Life, but everything I've heard, they seem pretty good. I don't know if they're the cheapest though. You have to do your research, maybe get a couple of quotes. All right, on to more important stuff. I will come back to Capitalize though to see if they respond to my help request. So the first thing I want to show you is here. I don't know how well you can read that. So this was written last month. A viewer sent this to me. This is an interview of Bill Bengen. He's the father of the 4% rule. He actually says the rule is now 4.7%. That's at the same time that Morningstar did a report and said, no, it's 3.3%. And you say, well, who do I believe? Well, you can believe both. They're both right, actually. I know that sounds like a lawyer answer, doesn't it? The reason they're both right is because Bengen is using historical data, and it is what it is. And we'll talk about why he's at 4.7% now rather than 4. And Morningstar projected future. They did Monte Carlo analysis projecting future returns, and their assumptions were pretty dismal, not just in the near term, which kind of makes sense given bond yields and stock valuations. But I think my understanding is, and I confess I haven't looked at the underlying data, but my understanding actually from Bill Bengen was that their projection of future returns was dismal for decades. I don't know who will be right or wrong. I don't know. But what he did here was he said, look, I don't think my 4% has changed. And he's increased it to 4.7 because he's increased the asset classes that he uses. And in the original research, it was just S&P 500 and intermediate term US Treasuries. Now you can see here, I don't know how well you can see that on the screen, but he now He uses US small cap, micro cap, which is smaller than small cap, mid caps, international stocks, and US Treasury bills, right, which are shorter term. And he gets to 4.7%. One of the things he points out is, look, it was sort of the late 60s that proved to be the worst time to retire, and that's the basis of the 4% rule. The 4% rule is not an average. It's the worst time you could have retired since 1926. That's how he did it. And others have gone back to 1871, and it's still like the worst time. But his point is, look, yeah, valuations aren't great right now, but inflation is really low. Even with the uptick recently, it doesn't compare to the 70s. Anyone's guess as to what the future holds. And that was really why the late 60s were so bad. It wasn't that we had a bad stock market. We had 2 bear markets over the next 10 plus years, but they didn't compare to 1929, where in 3 years we lost 90%. But the reason, it was a 1-2 punch. It's not just markets, it's inflation. What the future holds, I don't know. Could 2022 turn out to be worse than 1968 for retiring? Yeah, I guess we'll know in 30 years. By the way, I've been fighting a cold, so forgive me while I down some water during this live Q&A. It is one of the reasons why this whole 4% rule, and I'm pointing to something you can't see. Here it is again. It's really not the way I would think about handling my money in retirement. The ideal approach would be to have a withdrawal rate that's much lower than that, assuming you can still live comfortably in how you want to. But if you're somewhere in the 4% range, I would highly recommend guardrails. And I will do a video talking about the different approaches to guardrails. But the concept is easy. It's like, look, we might start at 4% or 4.7%, and we might adjust for inflation. But before we actually pull the money out, we're going to compare it to something. There's going to be some kind of rule that we put it through before we just blindly take the money out. And one approach would be to say, okay, I'm going to calculate the number, but then I'm going to compare it to my portfolio as a percentage. And if the number is more than, say, 6% of my portfolio, I'm going to cut that number down until it's no more than 6%. That's sort of a Michael Kitz's approach. Another approach would be to say, I'll just have a cap. I'll adjust for inflation, but say never more than 6%. So if inflation's more than that, I'll just take a 6% increase. Another approach that I've read, I think Guyton Klinger, the 2 guys behind this approach, and it's much more complicated than this. But one of the things they might say is don't take an increase in years where your portfolio's down, right? We could back test that or Monte Carlo simulation that 1,000 different ways. But I think some kind of limiter, if you will. The problem with blindly taking an inflation increase isn't actually, will your money last for 30 years? That's just part of the problem. One of the things that doesn't get talked about is that in some of those successful retirements when they do their analysis, and by successful, I mean you don't run out of money in 30 years, which is how Bengen defines success. They don't point out that in some successful scenarios, you almost ran out of money. And in some cases, long before the 30-year period, you may have gotten really low at year 21. But then markets turned around and you survived for 30 years. But living through that day to day, month to month, when you're watching your portfolio go down and you're about out of money and you're only 80 or whatever, I'm not sure. I don't know that I could survive that. I don't know what I would do. But I can't imagine just sticking to the asset allocation when you're just about out of money. That's something to think about. All right, one last thing, and then I see the questions piling up. This was actually a question from a viewer. He emailed it to me, and his question was this. His name was Keese. He watched the video where I talk about the 6-fund portfolio. That's just sort of U.S. stocks, small cap or small cap value, international, emerging markets, which are a subset of international, REITs. How many fingers is that? 5. And then bonds. Bonds could be 2 funds, but whatever. And he's wondering, he's followed the 3-fund approach, but he's wondering if I still recommend the 6-fund approach in 2022. It's a great question. And so I want to spend a couple of minutes talking about this. And I actually, again, want to do a separate video, but it's how we call tilting our portfolio or slicing and dicing it. And the theory is you've got sort of your core portfolio, say US stocks, international stocks, and bonds, do we tilt the portfolio towards small cap value or REITs or emerging markets? And the first thing I want to point out in thinking this through is that even a three-fund portfolio is tilted. If you think about a totally 100% pure passive portfolio, what would that look like? And what does that even mean? And I suppose one answer is, well, a portfolio that just simply mirrors the market for stocks and bonds. What would that look like? Well, take a look. First of all, this is from Zacks Finance, and this is just the US market for a moment. And this was 2019, I think. Yeah. So the number is probably a little different, but the bond market, 40 trillion. I don't know if you can how well you can see that, but it's right there. 40 trillion was the bond market in 2019. And the stock market, 30 trillion. What we would find out is that the bond market, the debt market, is actually bigger than the equity market. So first of all, if we're going to mirror that, we'd have more bonds than stocks. Certainly long-term investors, that's not the approach we take. So already, forget US versus international for a moment. Just the stock bond allocation, we're tilting. We're no longer purely passive if you have a 90-10 portfolio or even a 60-40. You're not passive anymore. Strictly speaking, you've tilted your portfolio towards stocks. And we can look at the global market. Here we go. This is current. This is Oh no, this is a year old. Sorry. But the U.S. market, and this is equities, stock markets, 56%, we'll call it, is U.S. So if your stock portfolio has got more than 55, 56% in U.S. stocks, you've tilted your portfolio. Now, I'm not saying that's a good or bad thing at the moment. I'm just saying that, even a basic three-fund portfolio is tilting towards stocks compared to the market as a whole. In most cases, it's tilting towards U.S. stocks as compared to the market as a whole. And so none of us are really purely, truly passive, completely passive investors. So then the question becomes, all right, Rob, fine, all that little nuance, great. What do we do? Do we do a six fund? Do we do a three fund? I've always done a six fund. I'm less convinced today that that's necessarily going to be long-term beneficial. All the research that I've done says that in terms of diversification and possibly outperformance, historically, if you're going to tilt your portfolio just one way beyond, let's just say, a standard three-fund portfolio, small cap value is probably the most bang for the buck. Now, and we can look at that actually. Let me pull up something else. Let's see what we've got. Yeah. So I was just doing some different things in Portfolio Visualizer. And so we've got US large cap, which would be S&P 500, US small cap value. I threw in REITs. And this goes back to 1994. And if we look at the ending results, small cap value is, the outperformer. Now, we could get into the details. You pick different years and REITs will do better. Maybe large cap will do better. But long-term, small cap value, and this is certainly true if you go back to like 72, small cap value probably gives you great diversity and outsized returns. Whether that will happen in the future or not, I don't know. I can tell you Jack Bogle wrote a book, and now the name is escaping me. Don't count on it. Let me show you this book. I think that's the right name. Don't count on it. Is that right? Jack Bogle. I thought that was the name of it. Maybe I got the name wrong. No, that's right. Here it is. There's the book. One of the things he points out in that book, as I recall, and it's been a while since I've read it, was that, yes, small cap value has outperformed long term, but it's done so primarily because of just a couple of years. If a couple of years went a different way, its outsized performance wouldn't look like it does. And his point is, don't count on it. Just because it's outperformed in the past doesn't mean it will outperform in the future. But again, focusing on historical data, small cap value has been good. Emerging markets have been a hit or miss. They've had some really bad years and some really good years, very volatile. Same thing with REITs. So I feel less strongly about those two categories than I do small cap value. But having said all of that, if I were starting fresh today, I'd probably just have a three-fund portfolio. I don't have that now, and for tax reasons, I wouldn't just switch to it because a lot of what we have are in taxable accounts. And I'm perfectly fine with a 6-fund portfolio. I mean, I think we'll do very well. Will we do better than a 3-fund portfolio? I don't know. I'm less convinced that all the slicing and dicing helps a lot. But again, part of it is personality, because really what matters more than which one will outperform the other is which one can you stick to for 30 years or longer. That's what really matters. All right, enough chit chat. And I took up 20 minutes. Sorry about that. All right, your questions. Scott, when rebalancing and analyzing, say at the start of a new year, do you think forward to events or trends that will or may take place? Midterm elections, pandemic. I don't, Scott. I think more about taxes and how I can rebalance without triggering them. And so there are times when I might not rebalance quite as much as I might otherwise because of taxes. And I use new contributions and reinvesting dividends as a way to maybe rebalance slowly over some time. But no, I don't look at current events. And in my experience, I'm just as likely to be wrong. Because ultimately what you're really asking is, are you making some judgment about the direction of the market based on these current events, right? And in my experience, I've been as wrong, I'm sure more times than not, but at least as much as I might have been right. And so I don't think about any of that. No. Marv, in 8 of the last 10 years, the performance of VTI, which is a total U.S. total stock market, I'm going to pull up Morningstar, beat VEU. I'm not sure what that is, but let's see. Oh, the FTSE All World, excluding the U.S., so an international fund. It has beat VEU. In the 2 years that international stocks beat U.S. stocks, it was only by a couple of percentage points. Should I rethink lower my VEU percentage asset allocation? It's interesting. One might say, should you increase it? I mean, things tend to go in cycles. Now, sometimes those cycles are long, but if one index has really beat another over a long period of time, and its valuations are much higher, a good argument could be made that the one that hasn't done so well, its time has come, right? But of course, that doesn't mean that this year it'll outperform or in the next 5 years. If we look at, let me show you on the screen. So here's the VEU. It's a Vanguard FTSE. What's that stand for? Financial Times Stock Exchange, I think. But if you want to be cool, you pronounce it FTSE. All world, excluding US, right? So that's what that is. Let's see here. We'll go to portfolio. It's got a PE of 13. Now, I think I'm pretty confident that's a forward PE. I mean, I think that's what Morningstar uses, which I'm not really a fan of, but that's fine for comparison purposes. 13. And if we go to VTI, it's going to be in the 20s, I assume. Well, maybe no. Yeah, it should be in the 20s. I'm going to guess around 21. What do I know? 21, 23. Okay. So now the thing about a PE, I think it's, an important data point. It doesn't mean, though, just because you have a high PE doesn't mean the stock price or the index won't go up. And just because you have a low PE doesn't mean it won't go down, at least for a while. But a value investor would look at that and say, boy, the international fund is a much better deal right now. Now, what I do is I just don't make changes. To answer your question, Marv, of course, I can't tell you guys what to do, but I can tell you I don't generally change my asset mix based on PE or my own assessment of value. There is one, let me show you one other thing if I can find it. It's the DFA, which is Dimensional Funds Advisor. DFA emerging, I think it's small, I think they have a small cap value fund, don't they? Let's see. Maybe it's just small cap. Maybe it's just small cap. DEMSX. This is not what I was thinking of, but let's just take a look at it for a second. I'll pull it up here now. So this is emerging markets, small cap, right? This is a pretty narrowly based, this is a really sort of niche investment, if you will. Yeah, look at its PE. It's 8. I have one that I think is around 7. It may be this one, because again, this may be the forward PE. I look at something like that, and I almost think, man, for my stock portfolio, should I put some money in this thing? I know it's not a stock; it's an ETF, or this is a mutual fund version. I think they have an ETF version, but I could be wrong about that. And I go down to their companies, and of course, I don't recognize a single one. But in any event, so I tend not to change my asset allocation based on valuations. Again, for the same reason I don't consider events when rebalancing. I'm just as likely to be wrong, maybe more likely. But the fact that, to me, the fact that international stocks have underperformed over the last decade, and then when you look at their valuations, to me, that's an argument in favor of international stocks, not actually against them. So that's my answer, Marv. Okay, Justin. I want to get the max benefit of a Roth IRA, no taxes benefit. Is SP 500 index or similar for retirement account too conservative? I don't think I can pick individual stocks worth a darn. Family show. So, well, to me, the question is a lot like saying, I'm going to make a meal and I want to know, how much sugar should I put in it? Well, I need to know what you're going to make and what all the ingredients are. So you need a plan. What's your overall investment plan, not just for your Roth, but all of your any taxable money you have a 401k. What's your overall recipe? Maybe it's a 3-fund portfolio, which could, I tend to think of total stock market, not S&P 500 for a 3-fund, but you could use S&P 500. We've looked at the difference and they're marginal. So the first question is, what's your overall plan? I certainly think an S&P 500 could be a good part of that plan. And then I would probably put in the Roth the thing that in my mind has the highest long-term expected return. S&P 500 could certainly be that answer. Now, let's say you have a 3-fund portfolio, but you decide you want to add small cap value because of the history. You don't know how to do in the future. None of us do, but you like its history. You're going to give it a go. And you put whatever 10% in a small cap value. I would tend to probably put that in the Roth, again, just based on future expected return. I don't know how it's going to turn out. It could turn out that international stocks would have been better in the Roth, because remember, we want our Roth accounts to get as fat as a tick. But I think your idea is correct generally, that whatever your overall plan is, what should go in the Roth, in my view, are mainly stocks, but and things that you expect to be the best returns. So I would never, for example, put bonds in a Roth account if I can help it. Now, some of you that may be all you have, are Roth. And then then obviously if you have bonds, they go in a Roth. But if you have choices and options. Okay, Fast Eddie. I'm parched. Hang on. Fast Eddie, should we be setting aside some cash so that when the market crashes, we can buy low? Don't stop doing what you're currently doing, just be ready. Well, I guess it depends. So in my approach, if I've got a 401k and I'm making regular contributions, my approach has always been I just put them in however I'm investing. I don't wait for some drop in the market. Again, it's kind of, in some ways, all these questions have been very similar, and my answer is the same. It's because I can't predict, right? There is one exception for me, and that is with the portion that I invest in individual stocks. I am looking for good values. And if I don't have any at the moment, any new money that I put into that account would stay in cash. It's not so much that I'm waiting for a market dip, because I'm generally not buying index funds in that account. I'm looking for an opportunity that I think might be a good one to invest in. And a lot of that isn't even so much what's going on in the market. It's how much time I have to evaluate things. Because I'm looking for very easy decisions. This is something Warren Buffett says. He'd much rather step over a 1-foot hurdle than to try to clear a 9-foot hurdle. What's the world record high jump? Is it 9 feet? I don't know. World record high jump. 2.45 meters? I don't even know what that is. Men, 8 feet and 1/4 inch. All right. So anyway, I look for really easy kinds of investments that I think are a no-brainer. But in any event, so in my individual stock portfolio, if I add money to it, I don't just rush out and put it in stocks. So in that sense, I'm waiting. It's usually waiting for me to actually do the evaluation and think about it. But for like my basic allocation, it goes in and I just invest it where it goes. Scott asks, when discussing the tax consequences on traditional IRA withdrawals, the generous standard deduction needs to be taken into consideration, or does it need to be taken into consideration as a possible offset? Well, sure, right? I mean, if you think about it, withdrawal from a traditional IRA, and I'm going to assume you're 59 and a half or older, or have some other exception to the 10% penalty, is going to be treated as ordinary income, right? Then the question is, okay, that's fine, but what are the consequences for you as a taxpayer? And that's going to depend on, any other income you have, spouse's income, where you live, and all those sorts of things. And of course, do you itemize or do you take the standard deduction? And so, yeah, I'm gonna want to look at effectively, if I take this money out, assuming you have an option, putting aside RMDs when you're older, what will be the tax ramifications? And in answering that, certainly, yeah, standard deduction would be part of that analysis for sure. By the way, I am working on a Roth conversion video, and I hope to have it published next week. And it's going to be a long one. It could be an hour long. I don't know. I will do timestamps, I promise. And the reason it's taken me so long, there are two reasons it's taken me so long. One is I've been looking at different tools to help figure out which tools might help you guys figure out Roth conversions. The second problem is I was trying to come up with sort of my own personal approach to how I'm going to deal with Roth conversions, if I have any at all. And I couldn't wrap my mind around it. The problem wasn't understanding Roth conversions or the math or the analysis. The problem is it's unbelievable. If you just have a list of all of the things that can affect whether a Roth conversion is a good deal or not, it is mind-boggling. I mean, you have tax brackets, of course, and taxes can change. You have where you live, right? Because the state income tax. Maybe you move. You do a Roth conversion now and you move later. Yeah, you don't know, right? You've got tax on Social Security, so you got to factor that in. Your IRMA, the extra you might pay on Medicare, that plays into it. Tax gain harvesting as a possible alternative. But you have things like whether a spouse dies, because in the year after a spouse dies, the living spouse files, unless they get remarried, files as an individual. Now all your planning is gone because now your taxes are different. I mean, the number of things that we can't possibly know is it just goes on and on and on. But I think I finally figured out at least my approach to it and why. The one thing I will tell you, and I think I mentioned this last week, if we assume you pay the tax on the conversion out of the money you're converting, so you take 10 grand out of your IRA, 2,500 or whatever goes to Uncle Sam, the other 7,500 goes into a Roth. Let me stop there. This would apply for someone 59 and a half or older, right? Because otherwise you hit the 10% penalty on the money you took out and gave to Uncle Sam. But if that's what you do, then it all comes down to the taxes you pay on the conversion versus the taxes you would pay if you didn't convert and took the money out later. Which one's higher or lower? That's it. Doesn't matter how long you keep the money in there, higher or lower. If you pay the taxes from, say, your checking account, so you move 10,000 from traditional to a Roth IRA, let's just assume 2,500 is taxes, you pay it out of your checking account. Now, how long you keep the money in there makes a difference. And what it means is the longer you keep your money in the Roth, the higher the tax can be at conversion, and it still be a good deal. You can actually pay a higher tax at conversion than you would have when you took the traditional money out and still have it pay off. And there's formulas for figuring all this out, and I'll talk about it in the video. But when you factor in all of the different things that can cause your taxes to go up in the future, I think Roth conversions are pretty smart in many, many cases. And in our case, I could see the Roth staying there for decades. So anyway, it's complicated. Mike, welcome to the chat. He's the crazy man in the pink wig. Here's a great question from Thomas. Any tips to stay strong mentally in the market during volatile times? We've had a couple bad days here. Now today, I think the market's up. Yes, it is. Here it is. Again, these are just, most of these I don't invest in. They're just things I'm interested in. And look at this, ARK's up almost 5% today. Anyway, yeah, it's been a rough market. So there are a couple of things. The first is be a historian. Understand that the market goes up and down in big swings. That's what it's done forever. And as far as I know, it's going to continue to do that forever. And so we might be surprised at when a market turns and maybe why, but we shouldn't be surprised that it happened, right? We should expect it. And if you're that's the first thing. The second thing is, if you're still in the accumulation phase, 20s, 30s, 40s, maybe even 50s, you should welcome a downturn because you're now buying at cheaper and cheaper prices. It's the best thing. If you're 20 or 30, the best thing that could happen to you is the market loses 90%. I know that's extreme, but it's true. So that's the second thing. The third thing that I would say is, when people talk about withstanding a bad market, they always talk about your asset allocation and your risk tolerance. And that's all fine and well. But at the end of the day, I think how you handle all of your finances outside of your investments is a significant factor that gets overlooked. If you go into a bad market and you're leveraged to the hilt, even not for your investments, but you've got a mortgage you can barely afford and 4 credit cards maxed out and 3 car payments, it's hard. It's, and fixing that is not something you can just do overnight. I understand that. But if you go in and you have no debt, or your debt's very manageable, I think it's much easier, not easy, but much easier to manage a down market. So, by the way, even if you're older like me and maybe not contributing as much as you once did, even a down market, particularly, there can be some benefits to a down market, right? Because if you reinvest some dividends, you may be spending them. But if you reinvest dividends, you're reinvesting at a lower price. But even if you're spending the dividends, as companies do share buybacks, they're buying back at cheaper and cheaper prices, which is a benefit. I mean, not when you're 70 and the market crashes, that's probably not going to give you a lot of comfort, though. But those are how I think through the issue. VJ, welcome from Ann Arbor, Michigan. I thought I ticked the box to exclude all people from Michigan, but apparently I failed to do that. Just kidding. Go Buckeyes. Are you guys losing your coach this year? I heard he's going back to the NFL. I don't know if that's true or not. Anyway, the transition either from the NFL to coaching a college team or from college to the NFL, and yes, I know that implicates the Buckeyes and one of their past coaches, doesn't seem to go very smoothly. Is it really that different? I guess it is. Anyway, VJ asks, I have been auto investing since 2011 at $200 a month in taxable account at T. Rowe Price, ticker PRDMX. I have no idea what that is. We're going to find out. Let's see here. Put it on the screen for you. PRDMX. Diversified mid-cap, I guess that stands for growth, I'm guessing, GR. Okay, there it is. Expensive, 0.8 in any event. Want to move it into a low-cost small cap fund. Interesting. Are VSIAX or FISVX good options? We'll look at those. You didn't ask me this question, but I'm going to answer, or we're going to at least raise the question. So the first thing I would ask if someone came to me and wanted my opinion, my first question would be, well, why? Why are you doing it? There may be a good reason. I don't know, but I'd want to know why. The second thing I'd want to know, because I think you said, yeah, it's taxable account. What are the tax consequences? Anyway, you didn't ask me about that. So let's look at these funds. VSIAX, so this is just the Vanguard Small Cap Value Index. I think this is a great fund. And I am pretty sure I own it. Oh no, yes, I do. I do own this. So this is a perfect example of a fund that we were talking about, tilting your portfolio towards small cap value. It's very inexpensive, 7 basis points. You can see its yield, and not that that really means much to me, but whatever. People like the yield. I get it. We can see its value and small cap. We can actually look at the weights because it's going to have mid cap in here, as you can see. I don't know if that surprises people. You can also find what's called a micro cap, which probably wouldn't have any. Let me just show you that, because I know Bill Bingen in the article I mentioned micro cap. So I just want to pull one up. Bridge, I think was it Bridgeway? I used to invest in a micro cap years ago. I think it was Bridgeway. Bridgeway micro cap? Is that a thing? Or am I just totally making this up? Ultra small company. Bridgeway, here it is. Hang on, I'm going to find the ticker. BR6. Yeah, I invested in this years ago. Kind of brings back memories. Okay. This was this was way back when I was really slicing it. This is probably in the, I don't know, the 90s. Has this fund been around that long? It was when I thought, my thinking was, oh, small cap are good? Well, let's just do ultra small. On the expensive side, and the portfolio, yeah, look at the blue. It's like not even on the page. It's like off the tic-tac-toe board. Holy cow. Okay, and the weight, yeah, see, so it's like, so in fact, you really wanted to go, look at the PE. I mean, this is another example of a fund you think, maybe instead of investing in a stock, I'll just put some money in this for a while. I mean, look at that PE. Of course, one thing about the PE is I want to look at the historical PE for this fund. I mean, maybe 8.8 is their average. We think it's low. Maybe it's not. Anyway, sorry, VJ. I know you didn't ask me about this fund, but I think this is a solid fund. I invest in it now. Tracks an index. It's nothing fancy. Price to earnings is a lot lower than the S&P 500, but that's going to be true of just about any small cap that I know of. Maybe a growth could be an exception. And here, you can see the kinds of companies that it invests in. And then the other one that you mentioned, which I think is a Fidelity fund, right? FIS, right? Yeah, VX. Yeah, small cap value. Also cheap, even cheaper, right? Portfolio, small cap value. The Vanguard is a little tilted a little more towards value, I think. No, it's not. It's actually larger and about the same. This has actually got smaller companies, which is kind of interesting because this is an index. They obviously track a different index. You can see some of their companies. We can actually figure out what indexes they track, right? So let me show you that. So I'm going to Google these tickers to pull up their respective websites. So I'll pull it up on the screen in just a second, and we'll look at. Okay, so here's Vanguard's. See if I can make it a little bigger, maybe. I'm looking for what, and so we might have to go, well, let me go to portfolio and see if it tells me here. Of a benchmark index, but they don't tell you which one. Oh, here we go. So that's the index it tracks. If we go to Fidelity, it's got to track a different index, right? Russell 2000. So, again, I don't know that one's better or worse. We could certainly look at performance over time. We could do that here. So we could go to Portfolio Visualizer and put these two funds in the portfolio screen. We'll do that briefly. I don't know how much how much weight I would put on this really, because they're very similar. But of course, you have to make a decision. But if you're wanting small cap value, these are probably both good options. So why is that? Oh, is this a new fund? Fidelity, only goes back to 2020. That's interesting. So one way you could get more data, right? This is where understanding the index could help you. I'm not going to do this, but you could simply find another small cap value fund that tracks the Russell 2000 value index, right? That's been around longer, and that would tell you. And here's the Russell. Actually, the value tells you at least some data. Well, let's actually use this. So for 10 years. It's returned it's returned 12%. You would expect Fidelity to just be under that a little bit because of the expense ratio and transaction fees, right? So it's 12%. We'll just call it 12% for 10 years. And here we can go to the Vanguard fund and look at 10-year. It's been 13.3. It's actually outperformed a bit. Performed a little bit more than the Russell 2000. I don't know how much I'd read into that. I think they're both good funds from what I can tell. There you go. Hope that helps. James iBond. I just made our iBond purchases this morning for 2022. I have a 401k, two 401ks with former employers, a Roth IRA, and a taxable account. Interested in transferring the two 401ks into a rollover IRA and making backdoor Roth IRA contributions. Pitfalls. Well, so they may change the rules on backdoor Roth IRAs this year. That's the first potential pitfall. And I don't know if they're going to do it. I don't know if it's going to be retroactive. I can't imagine, I don't know how you'd make it retroactive if people have already done the backdoor Roth, but it's at least a pitfall, potentially. I can't tell you what's going to happen. The other thing, of course, you're going to pay taxes, right? I mean, really, I don't even know if this is, I'm not sure I'd call this a backdoor Roth. If I'm understanding your question, you want to take old 401ks. So I'm assuming they're pre-tax. That's an assumption. So you can convert them. So if they're pre-tax and you're just sort of converting, you take the 401k, you move it to a rollover IRA, and then you convert it to a Roth. Assuming it's all pre-tax, you're going to pay taxes on it. Just a Roth conversion, really. Normally when you think about a backdoor Roth, the idea is I make too much money to contribute directly to a Roth IRA because there are income limits. So what I'll do is I'll contribute to a traditional IRA and then immediately convert it to a Roth. So if the effect is as if I'm contributing to a Roth, but I'm doing it indirectly. That's why they call it the backdoor Roth. And because I didn't take a deduction on the IRA contribution, it was all after-tax money, the conversion doesn't cost me anything, assuming you do it, right after you've made the contribution. But in your case, so that's a question, I don't know, but you're asking me for pitfalls. That's one. Another one would be, even if it is after-tax money, you have to remember that if you have other IRAs, you can't cherry pick and say, okay, I'm just going to take it from this one, and it's all after-tax money, and so I won't pay any taxes. If you have pre-tax money at other IRAs, the federal government treats that as all one big pot, and they'll do a pro rata thing where they'll say, okay, whatever, 20% of your money is after tax, and 80% in the other IRAs, when you add it all together, is pre-tax, and so some of that conversion could be taxable. So you have to understand the pro rata rules. So those are at least a few of the pitfalls I can think of off the top of my head. I'm sure there are others. If I've missed any, maybe the chat can help us out. What other pitfalls have I missed? Yuri says, and he's a CPA, So I'm going to have to read this with care. Maybe a trick question. You have previously mentioned, see, whenever it starts that way, I'm nervous. What did I say? I don't know. Probably not something smart. You have previously mentioned you're not a fan of keeping all your investment accounts with the same broker. Oh, that is true. Can you please elaborate a little more on this? Well, sure. I think, what if one of them gets hacked? I don't know. My account gets compromised. Even if down the road it gets returned to me, maybe it's a mistake by the broker, or it could be, I don't know, somehow, my password got compromised, or I do have two-factor authentication on everything, and I highly recommend you do too. But that's my thinking. Is I'm just worried about having all of our assets at a single broker. So I actually have spread them across 3. Yeah, that's why. It doesn't really affect, I suppose you could say there's some sort of an extra management headache, maybe. But the way I have it set up is retirement accounts all at one place, taxable mutual funds in another, taxable individual stocks / cash at a third. That's how I've divided it up. And at least so far, it's not that big a deal. I use personal capital to see everything in one place. Actually, the brokers too have tools now where you can link your external accounts and see everything in one place. I think they all do. All right. That wasn't so bad, Yuri. Now, I don't know if my answer makes any sense. Maybe I'm overly cautious, but all right, Neil. Any advice on keeping a level head in an ever-changing up and down market? I think I kind of answered this. Lots of volatility lately. Also, yesterday's presidential speech gave me zero optimism for the future. Boy, I don't know. Oh, that's right. He did do a speech on his first year. So, I gave you my thoughts a minute ago. One thing you might do, this is going to be an oddball recommendation. I am reading the biographies. My plan is to read a biography of every president. And I'm on John Quincy Adams. There were a few James in the first few presidencies, particularly that number 4 and 5 spot. John Quincy Adams, number 6. And I love biographies generally. I mean, I finished one on Rockefeller. That was fascinating. I've done one on, I read William Randolph Hearst. Interesting character. I want to read one on Morgan. I want to read, and I've got a couple on, I like the tycoon biographies, but I also like political stuff. And I know that may seem like it has absolutely no relevance to this question, but it goes to the whole political thing. Because I know, particularly if you have strong feelings about politics, one way or the other, it can be easy to sort of get into sort of a gloom and doom kind of perspective. And I'm not saying that's what Neil's doing, but I get it. And it doesn't matter what party, depending on what party you're behind, then who's in office, you feel one way or the other, whatever. But when you start to read our history of our country, it's like, man, I'm just amazed we're still here. Got to be honest with you. I mean, the whole first 20 years, I'm just stunned that we survived. And all the sort of, I don't like politicians who demonize the other side if they don't agree with them. And it's more of a personality thing than a party thing. I think I just don't care for that. I'd rather discuss the issues. But when you read history, I mean, we've been doing that. I mean, you go back to the very first administration. Now, George Washington was not like that. He was definitely not a demonizer at all. But a lot of people around him were. His second term, much rougher than his first. Same true with Monroe, by the way. And Monroe was not a demonizer at all. That just wasn't his personality. But, Jefferson, he could light it up. So could John Adams, Madison to some degree. And you read all of that, and you come away realizing, today ain't really that much different than 250 years ago, 230 years ago. And we've survived it. So, I don't know what the future is going to hold, but we've survived a lot of crap. And not just the United States, right? I'm working on a video on about my blue binder, which is this thing here. This is me. If I get hit by a truck, my family should, this tells them what's what. Part of it is this document. Let me just throw some of this off my desk. It's getting cluttered. All right. Part of it's this document, my investment philosophy. It's just 2 pages, a little more. But I want to read you part of it. This is sort of a note to my wife, right? Or I guess my kids. One final thought. Regardless of how you decide to handle our investments, remember one very important thing. A time will come when the market is crashing and you'll be tempted to sell everything and move to cash. These times usually involve a lot more than just a falling stock market. We may be at war. Unemployment and inflation may be sky high, or the banking system may be on the verge of collapse. Dark skies ahead. Don't sell. I even put an exclamation point, which I really am not a fan of exclamation points. Maybe I should take that out. Anyway, don't sell. Think, typo, think about all the bad stuff we've gone through in the past. World War I, the Great Depression, World War II, the Korean War. By the way, I could have gone back to the War of 1812. That was scary. We almost invaded Canada. Anyway, we kind of did, truth be told. Vietnam, 9/11, the Great Recession, COVID-19, the Ohio State Buckeyes not winning the national championship. That's not in here, but it could be. The economy and the markets move in cycles. The best investors know this and never panic during bad times. Just stay the course. I don't know. I might add to it. That's what I've got right now. I do think we're going to be in for a rough time ahead. I don't know when. I don't know what it'll look like. But I mean, with our valuations, how can we not? But all right. Next question. Black mill over 472. I don't know what that means, but the question, do the benefits of tax gain harvesting, and I'll talk about what that means, but increased cost basis of taxable account while in 0% long-term capital gain bracket, that's what it means, but we'll talk about it, outweigh the cost, rebuying stock at a higher price equals fewer shares equals less dividends? Well, I'm not sure. So tax gain harvesting, let's say you buy an investment, if this is in a taxable account, you buy an investment for $5, it goes up to 10. If you sell it, assuming you've held it for more than a year, you would have a $5 long-term capital gain. However, depending on your tax situation, your tax on that gain could be 0%, and we can actually look at that. So capital gains tax brackets. Oh, NerdWallet. All right, here we go. Let's talk about how these work. So that's 2021. Do they have? Well, where's 2022? Oh, here we go. 2022. We'll look at this. So if you're single, up to $41,675. In capital gains is 0%. There's a big caveat I'm going to come to, so just hold on for a second. And married filing jointly, it's over 83 grand. Here's the caveat. You got to understand how ordinary income, like from your job, right, or interest that you've earned, works with capital gains. And ordinary income will fill up that capital gains tax bracket first, right? So if you're married filing jointly, $83,350. If you have $83,350 in ordinary income, that you can imagine that being at the bottom. Any capital gain sits on top of that and you'll get taxed, right? And so, but let's say you're married filing jointly and you have $40,000 of ordinary income, taxable. We go back to this, then that would give you the rest up to $83,350 at 0% for capital gains. And when I say taxable, I'm factoring in, it wouldn't just be your income. You'd subtract the standard deduction or itemized deduction if that's, depending on how you file. But the point is, the ordinary income fills this up first. It's not taxed as capital gains, but it can push you out of this nice 0% bracket, which is why, by the way, and Kitces has written a lot about this, $1 of income. So, if you have $1 of income that pushes another $1 of capital gains into the 15% tax bracket, that tax on that last dollar is a lot more, right? It's whatever you paid on the ordinary income side, plus that extra 15% you pay on the capital gain side, in any event. So the theory of tax gain harvesting is if you're still in that 0%, given all those, what I just described, go ahead and sell the $10 investment you'll recognize that $5 in capital gains, but it won't cost you anything, at least at the federal level. State is totally different. You got to factor that in. But at least at the federal level, won't cost you anything. And you can go ahead and buy the same investment right away. The wash sale rule applies for losses, but here you had a gain. What I don't understand from your question, though, is why that would, I mean, you have $10 worth of whatever, Apple. If you sell it, and that's X number of shares. Let's just assume for a moment it's 2 shares. If you sell it and then buy it back, assuming you do it soon, maybe even the same day, or I don't know, the next day, you'd still have the same number of shares that you sold. So I don't think, I'm trying to think how that would affect fewer shares and less dividends, right? And the other thing is $10 of Apple stock is $10 of Apple stock. How that gets divided in terms of number of shares, maybe I'm missing something, and I know the great folks in the chat will tell me that I've totally missed something. I just don't see that as an issue. And yes, if you joined late, if you want to ask a question, tag me in your question, because then I see it and I skip over everything that doesn't tag me. Also, I will do timestamps at the end. So, David, new investor here. Soon, I'm 69, not real sure what direction to go in at my age. We'll have close to $1 million to invest. That is an unusual circumstance, as far as I can tell. You're 69, you're a new investor, so you've never invested, I guess, and yet you've got $1 million to, maybe it's an inheritance, I don't know. Sorry about that. Well, I can't, of course, speak for you. If I were new, what would I do? Well, I'd first look at my overall financial picture. What debt do I have? Do I need to pay any debt off with the $1 million? Maybe yes, maybe no. 69, I'm assuming you don't say that you're retired, but I'm going to guess you're either retired or close to retiring. I'd want to factor in what other sources of income do I have right now? Social Security, pension. How much am I going to need? Am I going to start spending that money now as part of my retirement? Or maybe, for some folks, maybe they don't plan to spend any of it. They're going to actually give it to their children. They don't need it, right? So, there are countless scenarios, all of which would go into the question, how am I going to invest the money? If it were me and I were going to use it for retirement, I would probably invest it, again, in a simple 3-fund portfolio. There are other reasonable choices. And my asset allocation would probably be, for me, around 70-30. Some would argue 60-40. Some might even argue 50-50. I probably would never go below 50% in stocks, personally. But you can already tell from my answer that the approach is going to depend on countless factors that are very specific to you. So the one thing I might do, if I'm 69 and I'm truly a new investor, is I'd want to get some help. I hope, in my case, I wouldn't hire someone to manage my investments, most likely, because of the cost. Some people might, and that's okay. One of the things, by the way, this kind of reminds me of, I've gotten a number of emails over the years, and I'm sorry, I'm looking at my phone. I'm just making sure nothing bad is happening in the world. They'll say something like this: I've got a friend or a parent or someone older, and they're paying an advisor 1% or 80 basis points or whatever to manage their investments, and they won't listen to me. I'm trying to talk to them out of doing that because it's so expensive. What should I do? My thought is nothing. There are things a lot worse in life than paying an advisor 1%. Now, that may sound like crazy talk if you've watched my channel a lot. Yes, it's not what I do, and it costs you a fortune. But at the end of the day, what's most important is peace of mind, and you've got money to meet your financial goals. And so I don't want someone I love to be ripped off, but if they're comfortable, they're doing fine, they've had this advisor for 20 years, they're doing right by them in terms of the way they're investing, and they're going to be fine and set for retirement, the last thing I would try to do is talk them into managing all of their money by themselves. I just wouldn't do it. And so if I'm 69 and truly new to investing, I'd probably end up hiring someone to help me. I would preferably like to find someone that costs 50 basis points or less, and we've talked about different people that can do that over time. Vanguard is one option. They're 30 basis points. So I don't know, David, how well I've answered your question, partly because there's just too many unknowns. You really need to think through an overall financial plan. Even if you're going to manage your investments yourself, I'd probably talk to someone who can help me think through that overall financial plan. Matt, really appreciate all you do. Quick question about the investment tracking spreadsheet. How's come some of the ticker symbols don't auto-populate? Well, that's interesting. Well, let's do this. Best investment tracking spreadsheet. I'm still number one in Google. All right, I'm going to pull up this spreadsheet. This is what it looks like. Hang on. It wants me to log in. Why does it want me to log in? I guess because it's a Google Sheet. That makes sense. Hang on. Wrong. Okay, this is what you'll see, by the way. It'll say make a copy. Sure, let's make a copy. So I'm making a copy. So here's what it looks like. These are all made up numbers. And here's the holding sheet. Again, these are obviously Vanguard tickers. And the way this works is what ticker you put in here populates the name, it populates the price and the change in price, and this is the expense ratio that gets pre-populated. So what Matt is asking is some tickers aren't working. Let's see, VSIAX. I don't know. It worked for me. Assuming that's the Vanguard High Dividend Yield Index Fund Admiral shares. It worked. What about ICLN? That one worked. iShares Global Clean Energy. And the last one, TAN. No idea. Invesco Solar ETF. I don't know, Matt. They work for me. Sometimes it's all driven by Google Finance, and they have functions, and maybe sometimes they have hiccups. I don't know. Peter, should I invest in some asset classes like emerging markets in a retirement account just to get exposure if they don't have any low-cost options? The expense ratio is 1%, and the ticker is MMMPX. Well, the short answer, I can only answer what I would do, and I probably would not. I'm going to look up MMPX. Morgan Stanley Institutional Emerging Markets. Yeah, here it is, 95 basis points. I probably wouldn't. Not for something like that. If I had to, to get some sort of core portfolio, total US market, something like that, but I probably wouldn't. One thing we can do, let's just take a look. We can back test it. Let's do, we'll do that ticker, MMMPX. And we'll do Vanguard, which I think is and we'll analyze the portfolios. So how far? It goes back 7-8 years, 6-7 years. I mean, it hasn't done terribly, but its compound annual growth rate is noticeably lower. But again, it's a short period of time. But I personally probably wouldn't feel so strongly about emerging markets that I would pay 1% for them. I don't think. Oric says, sounds like bronchitis to me. Steroids, exclamation point. That's my diagnosis too, and I'll find out for sure tomorrow. I know that I don't have COVID, so I got that going for me. By the way, Oric, any chance you're a doctor? I don't know. Russ, any workaround for personal capital using current allocation for planning forecast rates. Want to see forecast based on retirement allocation. Huh. Russ, I don't know the answer to that. Any workaround for personal using current allocation for planning for? Well, maybe. Let me log into my demo personal capital account. I don't know if this will answer your question, but there might be a workaround. And I assume you're referring to the retirement planner. Okay, so here we go. This is, again, a demo account. Well, the M1 Finance is actually my account, but everything else is just made up. How's my M1 doing? I don't want to refresh it. Anyway, so actually I could go to holdings. Oh yeah. So anyway, here we go. M1, 35. That's my credit card rewards balance. I don't know if that's completely accurate. Hasn't been refreshed in a little bit, but enough of that nonsense. Planning. So we go to the retirement planner. I don't know if this is what I wanted to see was, whoops. Let's say I want to create a new scenario. We'll call this the Russ plan. What I was trying to find out, and by the way, I do have an answer for you with a different tool if we can't make this work, was if I could, excuse me, oh, here we go. No, if I could pick and choose which accounts show up and are used for the retirement planning and Alaska. I don't know that I can. No, I don't know that I can. I'll look into that more, Russ, but one thing you can do is a totally different tool and it costs money if you want to get beyond the basics is new retirement. So what you can do, so personal capital is good for taking your current portfolio and analyzing it, right? It tracks all your dividends, your asset allocation, everything. New retirement doesn't do any of that. That's not what its purpose is. And in fact, while you can connect your accounts in new retirement, there's really no need to, because it's not going to show you a breakdown of your asset allocation and all that. So I just have in my own personal new retirement account, the accounts, you need to know what type they are, right? Traditional, Roth, whatever, but the balance, and you update it once a year or whatever. But what you can do, to your point, is you can set the expected returns on an account by account level. So like if you had all bonds in one account, you might have a lower expected return. The other thing you can do is change so you can say, well, this is my expected return now. But if you think ahead, I'm going to retire in 10 years and my asset allocation is going to look different. So then I want the expected return to change and I want it to be this. You can do all of that in new retirement. But I don't know that you can do that in personal capital. Not that I can tell. I'll look into that though. All right. Gigi. Hi, Rob. I am a young investor and am mainly buying VU, which is the Vanguard's S&P 500 index ETF. It is about 97% of my portfolio. Is there anything I should do differently or should I keep buying VU? Well, the first question is, should you be 100% or nearly 100% in stocks? That's going to depend on countless factors. How old you are, how long you plan to invest, your risk tolerance, the condition of your other finances, as I've kind of alluded to earlier in the show. My general view is that for a long-term investor, I personally like 90-10 is the portfolio I would pick. Doesn't mean it's right for everybody. As I get closer to retirement, say 20 years out and moving towards 10 years out, I'm moving towards 80-20. For me, when I get to the point of retiring, which I define as living off of my investments, as I've said, I feel retired now. I mean, I get up and do whatever I want. In any event, what was I saying? I would probably go to like 70-30. That's me. There's, I think how much you're going to need to spend each year will dictate that to some extent. A lot of people might be 60-40. Some might be, J.L. Collins, who wrote The Simple Path to Wealth. I think he's 80-20. There's no one right answer, but that's the first question. What's your recipe going to look like? If you're 100% stocks, a lot of people would say VU is all you need. I personally like international exposure, and there are a lot of people that don't. If I were going to be 100% stocks, though, I'd have some international exposure too. It's my approach. But, Warren Buffett has said for his wife, 90-10, the 90% in S&P 500. But what does he know? Just kidding. Warren, if you're watching, I was just kidding. Cass asks, with increasing instability in American democracy. So this is sort of the second sort of political kind of ish question. And the very real possibility that political violence could derail the economy. See January 6th. Is it becoming too risky to keep the core of your retirement account in an American index? Well, and then he says, or she, I don't know, at what point does it make more sense to move your core to the international market to trade some gains in the exchange for stability? Well, I'm personally not I don't view, I'm trying to figure out how I can answer this without wading into politics. I view what happened January 6th as a demonstration of just how strong our democracy is, because we were just fine. Now, some might say, well, but if it had gone a little different way, maybe this, again, I go back to history. I don't know. It doesn't compare to things going on in the first 5-6 terms in office. My goodness. Scary times. So I guess I don't view our democracy as fragile as others do. No, I could be wrong, right? What do I know? So I'm not as maybe as concerned as other people are. But having said that, I tend to have more in international stocks than a lot of people do anyway. It's usually about 30%. So, but I can't see like going all in on international or significantly to international and leaving effectively Microsoft and Apple and these worldwide companies because of what happened on January 6th, or just some general view that our political system is fragile. One of the things that we get to do in this country, and that we're not alone, is throw people out, whatever your political views are. We don't like you, you're out. Now, depending on how strong you hold your political views, sometimes you're happy with who's in office, sometimes you ain't. That's, I guess, life, right? But I kind of think our political system, no political system is perfect, and eventually, if history tells us, empires collapse. But ours is pretty resilient, I think. That's just my view. I don't know. Is anyone still watching? Maybe after that, they're like, oh, it's a political channel. I'm out. I can't believe he mentioned January 6th. This is supposed to be a finance show. That's my take. I don't, we have some headwinds as a country. To me, though, the political system, the bigger issue is not like a January 6th. And I have strong feelings about what happened. But to me, the thing that frustrates me the most right now politically as it relates to our finances, and I've alluded to this before, the Republicans come into office and cut taxes. I'm not here to say whether it's good or bad. You have your own views, whatever. They cut taxes, and which can increase our deficit. It can also stimulate the economy, but it can increase our deficit and debt. Then the Democrats come in, and what do? Well, they increase taxes. Again, these are broad generalizations, but what they do with that is generally not fill the hole created when the Republicans cut the taxes, but they spend it on new programs. So our political parties are sort of working, they're not working together, but as the effect is that they come together and and increase significantly our deficits and debt. And of course, one party blames the other party blames them. We all yell and spit at each other, and we've got 30 trillion in debt, or something like that. That kind of concerns me. So maybe I am concerned about that, but it hasn't caused me to change how I invest. I don't know. I can't predict the future. What do I know? I thought it would be fun to have a political show, but I'm not going to do it. And I don't even know exactly what the angle would be. I tend to be conservative in some respects and not as conservative in others. I grew up believing you kind of make your own way. I had a paper route when I was like 14, you had to be 16 to get like a real job, like a fast food restaurant. Literally, on my 16th birthday, my mom drove me. I remember I interviewed at Mr. Heroes, a sub shop in Ohio. I got the job, and I worked there till like 1 a.m. on school nights. I loved it. Made money, made $3.35 an hour. Ka-ching. Then I got a big raise because I went to Kroger. Kroger is unionized, or they were. I guess they still are. I don't know. But I went from $3.35 to $3.40. True, I paid 7 cents an hour to the union, but $3.40, that was big time. I don't know. It's just, you kind of work for it. That's just what I don't know. What do I know? All right, enough. That's about as much politics as I can stomach. Quincy, small cap value isn't a consistent outperformer, though. It's episodic. Well, that's probably true of anything. Even an outperformer is not always an outperformer, right? But let's take a quick look. We're just going to go to asset allocation. Here, I'll show you. We're in Portfolio Visualizer. We'll do US large cap, which would be an S&P 500. And we'll do small cap value. And we'll look at it from 1972. Obviously, the number is huge. Can you imagine 10,000 into 7 million? Sure, it took 50 years, but still. But if we look here, so blue is large cap, red is small cap value. So even the first year, 1972, large cap won out, and then it won out again the next year, even though they were both negative. And there's some big years early on where small cap value really trounced, right? I mean, a lot of these years right here. And this kind of, in a way, maybe gets back to John Bogle's point of view. Let's just see something. Let's look at it from 1984. So we're going to cut out these big years where the red line is really crushing the blue line. We'll start in 1984. Now, the thing, let's see. I'm coming back down before I hit analyze. This is still the old years. 14 versus, we'll call it 11 for compound annual growth rate. Well, look at that. Much, much different. Now, small cap value outperformed, but, and it's over a long period of time, so the number gets big, but we're talking what, 60 basis points. So, and there were plenty of years, look at this in 1990, small cap value was down 19%. Large cap was only down 3%. So yeah, it's absolutely true. And what the future holds, that kind of, in a way, I hadn't done that before, but in a way, it kind of supports John Bogle's view in a way. It was more than just 1 or 2 years, but you even if you're looking over long periods of time, if you change the starting time period, the results can change dramatically. Matt, I am trying to majorly, I'm not sure if that's a word, but okay, I like it. I'm trying to majorly refurbish my taxable portfolio. Is there a way to do this but reduce long-term capital gains? Sure, just wait for the market to crash. Okay, is splitting up the sales between 2 tax years helpful? It's only about 12,000 of gains. Well, we can go back to the chart. So, I can't speak to state income tax. You need to factor that in. But if you're, let's say in both years, whether you do it all in 1 year, all in the other, or split it up over 2, what you're federal tax rate going to be? If both years are going to be, let's say 15%, because you're somewhere in this, I'm just, again, this is assuming married filing jointly, and let's say you're at 200,000. I'm just making up a number. And so adding that extra long-term capital gains, isn't going to put you in the 20% category, then it might not matter. However, and this is where you got to be careful. You have to factor in not just capital gains, but other impacts. Like, could it affect, maybe you're getting subsidies for Affordable Care Act. Will it put you over, what is it, 250, I think, for the net investment tax, the Affordable Care Act tax? I think it's 250 for married. ACA net income tax, 3.8% is the amount. Yeah, here it is. And here's the thing. These numbers, here it is. So it's 250 if you're married, filing joint, anything over that. This is not indexed for inflation. So this is it's like the alternative minimum tax. It's going to ensnare more and more people. Obviously, it's different. So you got to factor in all of those things, Matt. Make sure you understand the total tax consequences of triggering that extra income, capital gains. So it's not just the bracket. But you want to look at that, the bracket, maybe by splitting it, you can fit it all in the 0%. I don't know. Then it would matter, right? So that's how I would think through it. Yeah, I think. But I'm not a tax expert. So I could have totally missed something that you should also take into account. So I guess that's my way of saying talk to a tax professional if you need real help. But Gus, I have accumulated 1 million in TI stock. Is that Texas Instrument? I guess it is. TI. It's not coming up Texas Instrument. Hang on. Does Texas Instrument even exist? Is it public? Maybe it's not public. Well, it's TI.com. Anyway, I'm not sure what TI stock is. So anyway, 1 million in TI stock in my taxable account at Fidelity. I'm 75 and an ex-TI employee. That's got to be Texas Instrument. I'm looking to see if they have an investors page. Oh, investor relations. They do. Okay, I'm going to assume it's Texas Instrument. I don't know why it didn't come up in Morningstar. Uh-oh. Wait a minute. I have lost my records, so can't get cost basis. Should I just let my heirs inherit it? Is there no way you can reconstruct it? I mean, this is maybe like from some employee stock purchase plan kind of thing. I don't know. I don't know the answer to that because, first of all, I don't know how the IRS would handle that. I don't know. That's an interesting question. So Texas Instrument is TXN. That's the ticker. So I don't know what TI is. But in any event, it's not really important to your question. Taxes on investment if I don't know the cost basis. Well, Schwab has a helpful article. Save on taxes, know your cost basis. I don't know how that, I don't know. I would talk to a tax accountant first. Yeah, I don't know. I wish I had something smart to say on that question, but I don't. Ram says adjusting for current events is same as market timing. Yeah, it's probably true. Quincy. Motley Fool really likes VWIGX over VXUS. It's active, but good managers. Outperformance as well. Thoughts? So, I talked about some advertisers at the beginning. In theory, I can promote Motley Fool's newsletter. Now, the reason I say in theory is because I don't. I actually signed up for it. I'm not a fan of investing newsletters at all. And theirs is okay, I guess, but I've never invested on based on anything that they've had to say. I'm sure there's a lot of smart people there. What do I know? But in any event, so we know VXUS. We'll come back to it. So it's VWIGX, which is Vanguard International Growth. Is it an actively managed fund? Oh, it is. Here it is. So here it is. It's 43 basis points. And we're going to compare that to VXUS, which is a index fund. You can tell just from the cost. This is 8 basis points. But what I want to look at first, so the first thing that troubles me about the comparison, Quincy, is this right here, this investment style box. I don't know how well you guys can see that on the screen. So this is a large growth fund. You can see the little black dot in the top right. Let's go over to portfolio. We'll see it. It'll be bigger, and it won't be black. It'll be blue. There it is. So it's really large and really growth. This, I'm going to guess, should be a blend, right? Yeah, blend. It says right there, but we can go to portfolio. And there it is. It's in the blend category. So let's stop right there. If we want to think about a core international portfolio, I think you want to blend. It's like an S&P 500 for U.S. stocks or a total U.S. stock market. It's not trying to bet on growth, which are companies that are increasing their revenues and cash flows at a greater than normal pace, but tend to be more expensive relative to their book value or their earnings. That's growth. Think tech companies as an example. Value, they may not be growing as fast, but they're inexpensive relative to their earnings and book value, at least as compared to the growth companies. So value could be a drug company, could be a bank. And sometimes growth outperforms, as it has over the last number of years. Sometimes value outperforms. But for the core portfolio, I kind of want a little bit of everything. Right? I'm not trying to make a bet one way or another. And so for me, saying, well, I like, what's the ticker? VWIGX better than VXUS, to me is kind of like saying I prefer apples to oranges. If you wanted to tilt your portfolio towards international growth, then the Vanguard fund, this one right here, might be a decent option. But I certainly, for me, I wouldn't put all of my international in a growth or value fund. I would want it in a blend. And then if I wanted to tilt one way or another, I might do that with the second fund. Might be this one, maybe. You can see, by the way, you'll see the growth in the valuation. So this is the growth fund. It's got a forward PE of just under 26. Vanguard's is 13, right? Again, that doesn't make one better or worse. It certainly makes one more expensive relative to earnings than the other. But my answer to that question, Quincy, is I really like VXUS as sort of a core portfolio. If you wanted to tilt towards growth, I never have. That doesn't mean it's not a valid approach. This might be a reasonable option. I would compare this to, let's look at Vanguard International. Let's see what comes up. International growth. Here we go. Oh, that's the same one, right? VWILX? No, it's a different one. Let's see if this is an index fund. That's 32 basis points. Probably not. Vanguard International Growth Index. Well, let's search it and see what we get. Well, come on. I know they have a growth index fund. Hang on. Vanguard International Growth Index. Is anyone even still watching? A few people. So they come up with that VWIGX. Maybe they don't have an index version of this, which kind of would surprise me. Well, let's do this. Forget Vanguard. We don't need Vanguard. Fidelity, International Growth Index. This might be it's interesting. I can't find, okay. International Growth Index, forget Fidelity. Does one exist? 9 best foreign large growth funds, according to US News. ProShares, that's their number one. Really? Wisdom Tree. Oh, global excluding US qualify. Yeah, that's not even a. Anyway, Oh, here we go. How about EFG? Let's see here. What's this? Oh, that's iShares Growth ETF. Still 35 basis points. I wonder if that's an active fund. I don't know. Anyway, enough of that. I would find a growth index fund if one exists. I'm sure they do somewhere to compare to VWIGX. I don't think comparing it to VXUS for the reasons I mentioned, I probably wouldn't compare them. Quincy, Advantis also has small cap value international. Okay, good to know. I need to do more research on Advantis, and I also am going to do some more research on dimensional funds, DFA funds. And maybe I'll do videos on them because I think they both can offer good funds potentially. Also, people have asked about Wisdom Tree, so I'm going to be doing a dive on that too. This is from VJ. What is your take on Seth Klarman's book, Margin of Safety? I watched a few videos on the book, but not ready to spend $1,000 to buy the book. You don't have to spend $1,000 to buy the book. So Margin of Safety is a book that was published, I want to say in the 90s. I don't know. If you Google Margin of Safety PDF, you'll find this book online. And I think I've had it at times, but I haven't actually read it. I should. But it would be the kind of book if you're interested in being a value investor in individual stocks. And I've heard great things about it, but I don't have the details. But I think if you can find a copy of this thing, you don't have to buy it. I don't know if that's like illegal, like copyright infringement. Maybe it is. I don't know. Don't violate any federal laws, whatever you do. That's my legal advice. Even though I don't give legal advice on this show. If I were to give legal advice, it would be don't violate any laws of any kind. If I read that book, though, I'll do a little video on it. By the way, if you want a really good book to think about value investing and buying individual stocks, I'll show you one I like. It's by Robert Hagstrom. Here it is. It's called The Warren Buffett Way. This is the older version, 1997. They have, this is the third edition. There it is. 20. I thought maybe he even came out with one since then, but whatever. This does sort of a good job of walking through how Warren Buffett evaluates companies. I like it a lot. I've read it. Okay. Yuri. Oh, the CPA is back. If you plan to move into a bigger house 3 to 5 years from now, would you consider cash out refi option, given you have about $250,000 in equity? Well, I'm confused by that question. Cash out refinance of your current home, but for what purpose? If you're going to move in 3 to 5 years, wouldn't you just sell your current home then? So I'm missing something. If you can help me with that, make sure to tag me. I'll come back to it. Jason, I have never heard you talk about rental property investments. I'd love to hear how you think about those investments when designing overall portfolio strategy. Well, I don't have any rental property investments now. I did. A friend of mine and I started in 2005. It's kind of funny to think back on this. In Ohio, we bought HUD foreclosures. And at the time, depending on where you live, you might not find any HUD foreclosures. Depends on the market. Sometimes you've got a lot. And we bought foreclosures. We ended up buying 5 in total. And we rehabbed all of them. I think one was in really good condition. Many of them needed a fair amount of work. And we used what's called a portfolio lender. So in other words, we borrowed money from a bank that was going to hold the loan on their books. They weren't going to sell it to, say, Freddie or Fannie. The reason that's important is because if you sell a loan to Freddie and Fannie, or Freddie or Fannie, Freddie Mac, Fannie Mae, it has to meet all of their criteria. So with down payments, credit scores, all this stuff. If a bank's going to hold the loan, they call them portfolio lenders because it stays in their portfolio, then they don't have to satisfy those. And the reason that was important for us was they would give us a loan equal to 100% of the appraised value of the home after we were done fixing it up. And so we each put in, I want to say 10,000. And I think at some point put in a little bit more money, but it enabled us to buy 5 homes over a 3-year period. And that may sound risky, so you're highly leveraged, but we had the finances to deal with any problems, and we were able to get a rent equal to at least 1% of the total cost, including the rehab. So these homes, this was in Columbus, Ohio, or the Central Ohio area. I think the least expensive home we bought was in the $40,000 range, and the most expensive home was maybe 120, or maybe lower than that. So these were not, it wasn't like we were buying in New York City, and we could get 1% and sometimes more. So like that $40,000 home, I think we put 20 into it. Let's say we had 65,000. I think our first rent was like close to $1,000 a month, which is just crazy good cash flow. And so I was very much a value investor, even when we're talking about real estate, and it worked out very well for us. Now, over the years, we sold a couple over time, and then I sold another one. I think I sold a couple to my friend because he's still in real estate. I'm out now, but they did very well. When I did all of that, though, I really wasn't factoring that into my asset allocation, to be honest with you. I think if you have a big real estate portfolio, it may make sense. But even then, what would you do? I mean, maybe avoid REITs, maybe, which, tilting your portfolio towards REITs, which I've done. I don't know that I feel very strongly about that. I don't know that I would, though, change necessarily how I invested in the market. I didn't in any event. So, by the way, if you haven't heard, if you want to ask a question, tag me in the question. I skip over all the ones that don't tag me. Casey, are there different withdrawal strategies at retirement based upon your investments versus relying more on Social Security, equities versus bonds, or tax-deferred versus tax-free accounts? Well, it's a great question. So here's how I think about, there's kind of a number of questions in that. This is my approach. I don't change my asset allocation based on like Social Security in the sense of saying, well, Social Security is like a bond, so that'll be my bond allocation. That's not how I think about it. I take all the income that I might earn from Social Security, a pension, maybe you have an annuity. That's great. Once I factor all of that in, do I still need money from my investments? That's really the question. And if so, how much? The answer for some might be, I don't need any of it. I can live off of my fixed income. I'm going to invest what's left primarily in stocks because I plan to give it to family members when I die, to charity when I die, and I want it to just grow. That would be one kind of extreme case. Others might say, no, I've got Social Security, I've got other things, but I'm going to need 4% in year one off of my investments. And so to me, that's what matters most, is what percentage, of the portfolio will you need? Now, in terms of stocks and bonds, my approach is simply to rebalance every year. So it doesn't really matter if I take from stocks or bonds, if I'm rebalancing at the same time, and it gets me back to 60-40, 70-30, whatever my portfolio is. What accounts you take it out of, that matters from a tax perspective. The general sort of high-level rule of thumb is you spend anything that's going to be taxed anyway. So dividends and interest from a taxable account. If you're old enough and you have RMDs, it's going to be taxed anyway. So spend it. And then taxable accounts, because the tax hit's usually not as bad. You might have some long-term capital gains, but it's not going to be usually, you're going to have some basis. So it's not going to be 100%. Then tax deferred, traditional, then Roth. That's sort of the general rule of thumb. There are always exceptions, though. There could be a year where you want to keep your taxable income lower for some reason, or it's okay to increase it some for some reason. So those are just sort of general rules of thumb. One tool that will help you it's the only tool I know of. They'll run a scenario. It's called OnTrajectory, and I've been playing with this tool. Maybe I'll do a video on it. It's similar to new retirement in concept. The one thing that this tool will do, though, is analyze all the different ways you can take out your money from the different accounts and come up with the best approach, which may not always be sort of the rule of thumb that I just described. The problem or the limitation of any of these tools is that some of that is based on assumptions like tax rates and performance of the investments, and that's just a best guess. So that's a very quick, high-level, down and dirty response to your question. I hope that's helpful. Is VSIAX the same as VBR? This is from Clarice. I have no idea. VSIAX is the Vanguard Small Cap Value Index Fund. Here it is. And the ETF is VBR. Yeah, these could be the same. There's a couple of ways you can figure this out. We'll walk through that. Let me just show you. If we Google VSIAX, and I go to the Vanguard site, here it is. There's the thing. You'll notice they have this, are also available as an ETF. Well, let's see if that ETF is VBR. It is. There it is. They're the same. Now, we can come over back to Morningstar. So this is the mutual fund. It's 7 basis points. The ETF's probably cheaper. No, it's not. Same. I was wrong. Then we can go to portfolio. Whoops, not what I wanted to do. We're going to do that. Then I'm going to do that. Then I'm going to go here. There we go. All right. So we can look, just kind of compare the portfolio. You can see their nets are the same. We can look at their style box. We can look at the weights. They're going to probably be identical. Sometimes there can be small variations, but nope, it's the same. We can look at their valuation metrics. It's identical, right? And then we can look at their sectors or regions or country. We can look at their top 10. You can see they both hold 1,000 equity holdings. Yeah. So there you go. They are the same. Phil, hey Rob, is there a tool that compares the overlap of stocks between funds? For example, how many companies appear in both VU and VUG? Yeah, Morningstar is probably the best. I mean, if you want a complete picture, you need the premium version because they have a tool called X-Ray. But let me show you how you can get some of this for free. What are the tickers? Oh, VU and VUG. Okay. So VU is the S&P 500. VUG is their growth fund, I think. Yeah. So if you go to portfolio of both, we got VU on the left, VUG on the right, and we go all the way down to the list of companies. They'll show you the top 25 companies for free. Where are we? Here we go. You see this little plus? That little plus symbol is what you'll see when something is a paid version. So to see the full list, you got to be premium. But you can see the top 25. And there's a lot of overlap, but the percentages are different, right? So it's not just the companies, but it's also the percentages. So we can see, here's number 2. The other thing you could do is, you could probably go to the actual, in this case, Vanguard, and probably see an entire list. I don't know where on Vanguard you'd go. Well, the VU, you kind of know. You can see the list of the S&P 500 companies from a lot of places. But if you go to VUG, I'm just looking quickly to see if you go to, I'm not sure if it'd be in the prospectus, portfolio. Will they show you all the companies? I don't know. They show you the top 10. Top 10 holdings with weight. Oh, here we go. What's this give us? Oh, there we go. So you can find this for free, right? The thing that the Morningstar X-ray tool is good at is it'll list all the companies throughout your whole portfolio and what percentages of each company you have and which funds they're tied to. And it just takes that free data and makes it a little easier to evaluate. Joshua wants to know what I think of senior rate floating notes. I don't have any opinion on senior rate floating notes. Sorry. Dan, can you explain what is meant by factor investing? Well, a lot of what we talk about in some sense is factor investing. If you just Google, I'm curious what comes up if you just Google factor investing. BlackRock, what is factor investing? First, I have to agree to their cookie policy. Types of factors. So they have economic factors and style factors. That's not where I wanted to go. We tend to talk more about style. So these are, oh, here we go. So we talk about value, right? Or growth, size, small companies, large companies. There's other factors like momentum, as you see here. We don't tend to talk a lot about economic factors. I don't think. I guess with bonds we do. But that's all it really is. Half the battle of learning about investing is just understanding the concepts and what all the terminology means. That's probably true of most things. Oryx says the tax consequences of these small cap funds is dismal compared to S&P 500. Is that true? Vanguard small cap index. So here it is. We can go to performance distributions. Now, actually, if we go back to quote for a second, the yield is about the same as an S&P 500, roughly. Distributions. So no, and I wouldn't expect this from Vanguard, but no capital gains distributions. And the income, is just basically the yield. There may be maybe there are other small caps that are pretty bad. I don't know. I think someone's making fun of the fact that I took things off my desk to declutter. That's hurtful. Man, there's a lot of questions. And it's at 12:53. I am going to do a second version of this show, and it's probably going to be on a Monday night around 8 p.m., subject to approval from my boss. We'll see what she says. I'm just curious if there are people that would like to participate live and they're working, they can't, whatever. So I don't know if it'll be this upcoming Monday. See how I feel. There probably won't be a whole lot of notice. So subscribe to the channel and you'll get, and I think that if you click the bell, then you get noticed. I don't know if subscribing notifies you as well. I don't know. What do I know about YouTube? Matt, I have recently ditched my financial advisor. I am looking for an exit strategy from the mutual fund I was invested in. Sell them all now and invest in ETF portfolio. Matt, I can't answer that question for you. I mean, the big question for me will be taxes, right? That's the big question. Ram says, love this channel, among the few very balanced and neutral investing related channels on YouTube. Well, thank you. Question. Does it make sense to have dividend-paying ETFs like SCHD in a brokerage account? Well, I mean, in theory, you want as tax efficient, as you can get. But SCHD, let's take a look at it. So there's really two things you need to think about. The first is the dividend, right? So it does have a high yield. I mean, relative to like the S&P 500, 2.78%. So, you're going to get hit with that every year. How bad that is will depend on your tax situation, but it's the thing you need to understand. The one thing I don't know about Schwab, I've never looked at this, is if they also distribute capital gains. So we can go to performance and distributions. No, they don't, or they haven't, at least since 2019. This column is short term. This column is long term. Now, I guess I should have known that. This is an ETF, so of course they're not going to distribute capital gains. Sorry about that. I was thinking it was a mutual fund. So, you've got this income over here from dividends. It's not the end of the world, I don't think, but, it's going to depend on your tax rate, state income tax, your other income. It's certainly going to be higher than an S&P 500, which has about half the yield, right? If we go back to the quote page, this was 278, more than twice. Because if we look at like a VU, it's around $1.20, right? Yeah, 125. So I don't think that would necessarily personally preclude me from holding it in a taxable account, but if I had I guess the way to look at it is, what are all your investments? Well, I guess on the stock side, and are there more efficient? Like if you also have VU and you had a choice, one could go in your retirement account and one could go in a taxable account. I'd probably put VU in my taxable account, right? That's how I'd think about it. Generally, the higher the dividend rate, the more you want it in a tax deferred account. But again, all kinds of factors could change that. Gage says, thinking about going from 100% equity to 90-10 stocks bonds. He's 21. Which of these index funds would you delete for bonds? It's almost like a SAT question. I want to pick answer C, but that's not an option. Okay. 45% SWPPX, no idea what that is. 10% QQQM, I know what that is. 17.5% VU, that's VO. 17.5% VBR, 7% VXUS, and 3% VNQ. I don't know. I mean, we can look at all of those, right? Let's do it. At least the ones I don't know. SWPPX. Oh, that's just a Schwab S&P 500 fund, right? See it there. All right, fine. QQQM is just like you would think, NASDAQ 100. So it's a high growth, right? Tech kind of fund. VO is mid cap. All right. VBR, we just looked at that, right? Small cap value. These are good funds. I like all these funds. Don't like the giant ad that I have to look at. VXUS, we looked at that. Whoops. We looked at that earlier today, right? Total international stock. Are you guys memorizing all these tickers? I hope so. I'm not, but. And VNQ, which is that real estate? I can't remember. See? Oh, it is real estate. Sometimes it better be lucky than good. So that's interesting. What would I do? Well, I'm not a big fan of like a QQQ approach, which probably sounds stupid. Maybe it is because it's done so well. I wouldn't give up the 7% in VXUS, but you guys know my view on international, and that's not everyone's view. You have 45% in S&P 500, 17.5% in a mid cap, 17.5% small cap value. So together, it's basically the total market, but weighted towards smaller companies. I don't know that I would change that. I don't know. I might get rid of the real estate and maybe some of the QQQM, which would be sacrilege to many of you. Or I might just use current contributions and slowly move into bonds. If it were me. Is that correct? If it were I. I think it's if it were I. In any event, I was an English major, but we really studied Shakespeare. My mom would know the answer to that, by the way, and she's probably texting me now to correct me. So I don't know how helpful that is. You could shave off a little of the mid cap and the small cap. If I were going to do this, I might shave off 2.5% of each, ditch the REITs. That gives me 8%. Depends how you feel about QQQM. But there's like a gazillion reasonable approaches. Some would say, of course, stick with your 100% equity. You're only 21. All right, how are we doing on time? It's after 1 o'clock. All right, I'll do a couple more, and then I'm going to call it a day. The other thing is, the longer I go, the longer it takes me to do the timestamps. So like when I'm doing the timestamps, and I've gone for 2.5 hours, when I get to that 2-hour point, I'm like, if I'd have just stopped, I'd be done with these stupid timestamps. I will say that I enjoy doing the timestamps because I laugh at myself. I'm just saying. I'm not one to laugh at my own jokes. I don't really tell good jokes. I'm not really a joke teller. Did you hear the one about, that's just not me. Dylan, I want to invest into an ETF that tracks small cap value Indian stocks. What are your thoughts about the Indian market and what ETF would you recommend? I got to be honest with you, Dylan. I have nothing smart to add about that question. I don't know. It's not something I focused on. I do know that a lot of value investors have done a lot of investing in India. And in fact, one is I'm going to totally misspell this. So this book, The Dhandho Investor, I hope I pronounced that correct, by Mohnish Pabrai. He's a very well-known value investor. You can find him on YouTube, being interviewed. He, along with Guy Spear, had lunch, won the lunch with Warren Buffett many years ago. And he's done, I think, a lot of investing in India. And I think, here we go. He's from India, so that kind of might explain part of it. By the way, he's not going to answer the question, what small cap value index fund should you invest in? But he might have some perspectives if you do enough research on his work. I don't know. In this book, I read this book. It's been years ago. But I really don't have an answer for you. I'm sorry. So I know there are still a lot about questions outstanding. I wish I could get to all of them. There's just no way I can. Like I said, I'm going to try to do a second show. I don't know if I'll do a second show every week, but maybe this Monday. But I will be back next Thursday at the same time. So if this Monday doesn't happen, if I'm going to do Monday, you'll get notice of it on Monday. So like sometime in the afternoon, I'll set it up so you get a notice a few hours ahead of time. But I'll definitely be back next Thursday, and will do my best to get to as many questions as I can. So I hope this has been helpful. Keep in mind, I'm just a guy with a YouTube channel. You need to do your own research, your own analysis. If you want professional guidance, you need to hire a professional investment advisor or a tax advisor, depending on the question. Or, I don't know, whatever question you have. Some of them aren't all about investing and taxes. Political questions, I don't know who you go to for that. Good luck. But I do my best to try to, give you my thoughts and give you resources to use so you can maybe figure this out on your own. Hopefully you find it helpful now and again. And I appreciate all of you for watching. And again, sorry I didn't get to all the questions. I never get to all the questions. I think it's impossible, but that's good. There'll be more for next time. So there you go. By the way, if you haven't subscribed to my newsletter, it's below, a link to it is below this video, below all the videos. It goes out every Sunday. And basically what I do is it's very simple. I link to 3 things that I found that week that I think will help you invest, think about retirement, whatever. And they're not things I've written. The 3 things are almost always other perspectives. And then I have a section where I link to all the videos I've published and any articles I've published that week. And then a third section where I link to other things. Could be about fitness, could be about good shows to stream on Netflix. It's just sort of a mix of whatever. I'm trying to think what I linked to. Oh, last time I linked to, is it Wordle? It's a new game. Did I show you this? You guys are probably already ahead of me on this one. Here it is. So, so the idea is, I'll just show you this and then I'll call it a day. You have to guess the word of the day and you have no clues. So you just have to type in a letter. I think a lot of people might use a rise. And what this will tell you is yellow means it's in the word, but it's not in the second spot. Gray means it's not in the word at all. And a green would mean I didn't get any green. That it's, I've got the right letter in the right spot. And you try to guess the word, you got 6 tries. I don't know what I'm going to do here. See, because letters and words are not my friend. If these were numbers, I'd be better. Although I have solved it each time I've tried. My best is in 3 tries. There ain't no way I'm getting this one in 3 tries. I don't have a vowel yet. And look, I've used A, I, and E. So one thought is, okay, I'll start with R, right? And then I'm going to put some vowels in here to see what we're dealing with. And then we'll do that. Oh, that's right. It's got to be a word. I forgot. You can't just put random letters in. Well, anyway, I have to think. And when I have to think, it goes downhill. I'll have to think about what I want to do there, but I'm going to work on that. Anyway, there was an article about this, so I put it in my newsletter. So there you go. So you get a little mix of different things. That's the newsletter. It's free. It goes out every Sunday. And maybe that'll be of interest to you. That's it. That's all I got. Hope you have a great week. And until next time, remember, the best thing money can buy is financial freedom.